Have you ever actually done the math on your own life? Not the math of a stock chart, not the math of a complicated trading strategy, the math of a normal working day. You wake up at 7 in the morning, you spend time getting ready, you spend an hour getting to work, you work 8 hours, then you spend another hour getting home by the time the day is finished. You have given about 10 hours of your life to earn money. That is the bargain most people make. You work for money. But then ask the second question, what is your money doing while you are working? For many people, the answer is uncomfortable. It is sleeping, it is sitting in a checking account, it is sitting in a savings account. It is earning almost nothing, maybe 1%, maybe a little more, but not enough to keep up with the real cost of life. You are working all day while the money you already earned is lying still, losing purchasing power quietly. That is not a fair system, and more importantly, it is not a sustainable system. If you work every day for money, but your money never works for you, then you are locked inside a one-way relationship. Your time is spent, your energy is spent, your body is spent, but the money does not build a second engine. That is the core problem. Most people do not need a more exciting financial life. They need a more systematic financial life. They do not need to day trade. They do not need to chase hot stocks. They do not need to watch screens all day. They do not need to turn investing into another job. They need a system that allows capital to work while they live. That is what proper asset allocation is supposed to do. It should not feel like panic. It should not keep you awake at night. It should not require you to check stock tickers every 20 minutes. If your investments make you feel like you are trapped inside a casino, that is not financial planning. That is stress with a brokerage account. A good allocation should feel more like a machine. You decide the rules. You set it up. You press start. Then you let the system run. That does not mean there is no risk. There is always risk, but the risk should be organized. It should be understood. It should be sized. It should be balanced so you can keep living your life while the portfolio does its job. Think of a washing machine. You do not stand there staring at every spin. You choose the cycle. You press start. You trust the process because the machine is built for the job. That is how a lazy investment system should work. Not lazy because it is careless, lazy because it removes unnecessary labor. That distinction matters. Lazy investing is not thoughtless investing. Lazy investing is front-loaded thinking followed by disciplined execution. You do the hard thinking once, create a structure, automate the behavior, and then stop interfering with the system every time the market gives you an emotional reason to panic. This is where the $10,000 milestone becomes important. If you had $10,000 today, what would you do with it? Would you lock it in a fixed deposit? Would you buy an insurance savings policy? Would you leave it sitting in a checking account? Would you keep it in a bank because that feels safe? This is what many people do. They work hard for years, save $10,000, and then let it rot in the bank for a few dollars of interest. They believe they are being cautious. They believe they are protecting themselves. But if inflation is higher than the interest they earn, the money is shrinking in real terms, the number may stay the same. The purchasing power does not. That is the first major illusion. Saving feels safe because the account balance does not move violently. You do not open your bank app and see your cash down 10% in a week. There is no red chart, there is no scary headline attached to the savings account. But safety cannot be measured only by whether the number fluctuates. Safety must be measured by what the money can buy. If prices rise faster than your cash earns interest, then the money is losing power quietly. You do not see the loss as a market drop. You feel it at the grocery store, you feel it in rent, you feel it in insurance, you feel it in healthcare, you feel it when the same life costs more than it used to cost. That is the hole in the bucket. You are carrying water up a mountain, working hard, saving diligently, doing the responsible thing, but inflation has punched a hole in the bottom. The harder you work, the more painful it becomes to realize that effort alone is not enough. This is why the first myth has to be destroyed. The myth is that investing is dangerous and saving is safe. It sounds logical, but if inflation is around 3.3% and a one-year fixed deposit yields around 1.9%, then the real return is negative. You are losing about 1.4% of purchasing power per year. Over a decade, the real value of $10,000 can fall toward $8,700 in purchasing power terms. You did not lose money on a statement, but you lost what the money could do. That is why cash is not automatically safe. Cash is safe from volatility. It is not safe from inflation. Those are different risks. The second myth is that you need a lot of money to begin investing. This myth keeps people trapped. They think investing begins when they have $100,000, $200,000, or some large number that feels worthy of a serious plan. So they wait, they save a little, they spend a little, they tell themselves they will start later when the amount looks impressive. But $10,000 is already a meaningful starting point, not because it makes you rich immediately, because it is large enough to make the system real. At $10,000, a 6% return creates $600 a year, that is $50 per month. $50 per month is not enough to live on. It is not financial freedom. It is not dramatic, but it is psychologically powerful. It is the first time many people can feel that money is producing money without labor. You did not work those hours. You did not clock in. You did not answer emails. You did not commute. The capital produced something. That feeling changes how you see money. It is like planting a tree. In the beginning, the tree is small. It does not give shade. It does not bear fruit. It does not change your life, but it is alive. It is growing. You know that if you protect it, water it, and give it time, it can eventually become something much larger. $10,000 is not the forest. It is the first tree. That is why the milestone matters. The third myth is that investing means staring at charts and doing endless research. That may be true for professional traders, hedge funds, analysts, or people whose job is to study markets all day. But for most people working ordinary jobs, that is not the best use of time. If you are spending 3 hours every night researching individual stocks while your career, health, family, and sleep are suffering, you may be solving the wrong problem. Your time is valuable. Your human capital is valuable. If you are a normal worker, the goal is not to beat every professional investor in the world. The goal is to participate in the long-term growth of productive assets with a system you can actually maintain. The core spirit of passive investing is humility. It is admitting that the market is smarter than you in the short term. It is admitting that you do not need to predict every winner. It is admitting that your strength may not be stock picking, but consistency, income growth, savings, discipline, and time. Do not try to beat the market if you do not need to. Join it. That is often enough. Now, if asset allocation is simple, why do so many people fail? They fail because they do not have a system. They watch one video and buy one stock. They hear a friend mention a fund and follow blindly. They hear about a hot sector and chase it with no overall plan. They panic during a decline. They sell after a bad week. They buy after a big rally. They change strategies every month. That is not investing. That is reacting. A person who wants a healthy body cannot run 10 miles one day, then do nothing for 3 months and expect lasting fitness. Fitness is built by a repeatable system. Investing is the same. A dramatic move made once is less important than a boring structure followed for years. The question is not whether you can become excited about investing today. The question is whether your system will still be working 6 months from now, 5 years from now, and 20 years from now. That is why I like a simple 3-layer allocation for the first $10,000. The first layer is the safety net. 20% $2,000. This money is not for investing. That may sound strange in a conversation about turning $10,000 into $300,000. But this is one of the most important parts of the whole strategy. If you invest every dollar and then life hits you, you may be forced to sell at the worst possible time. A pipe bursts, the car breaks, a medical bill appears, you lose a job, a family emergency happens. Markets are down at the same time. If you have no cash, you are no longer an investor. You are a forced seller. That is one of the worst positions in finance. The safety net prevents that. The $2,000 can sit in a high-yield savings account, a high-yield checking account, a money market fund, a short-term deposit, or another safe liquid vehicle. The point is not to maximize return on this layer. The point is psychological and practical security. When you know cash is available, you can allow the rest of the money to work. This is a principle. Liquidity gives courage. People often think courage comes from personality. In investing, courage often comes from having enough cash to avoid panic. If you know a small emergency will not force you to sell, you can hold through volatility. If you know the rent or mortgage is covered, you can stay rational when the market falls. A cash reserve is not dead money. It is emotional stability, and emotional stability protects the investment plan. Many people fail at investing not because they picked the wrong ETF, but because life interrupted them and they had no buffer. The market went down, the car broke, and they had to sell. The strategy may have been fine, but the structure was fragile. The safety net makes the structure less fragile. The second layer is the growth engine, 60%, $6,000. This is the core of the allocation. The purpose is long-term steady growth. This is the money that should be working for years. It does not need to become rich next month. It needs to participate in the growth of productive assets over time. The simple structure is a 70-30th split inside this growth engine. 70% of the growth engine goes to broad stock market ETFs, 30% goes to bond ETFs or investment-grade bonds. For the $6,000 growth engine, that means roughly $4,200 in broad stock ETFs and $1,800 in bonds. The stock side represents growth. Broad stock ETFs such as VTI, VOO, or VT allow the investor to own a large basket of companies. VTI gives broad United States market exposure, VO tracks the SP 500. VT provides global stock exposure. Each has a different design, but the common principle is broad ownership. You are not betting on one company, you are owning a system of companies. Over the long term, stocks have historically produced strong returns because businesses grow, innovate, raise prices, increase earnings, pay dividends, and compound value. But stocks are volatile. They fall, they crash, they scare people, they can be down for painful periods. That is why the bond side exists. Bonds represent stability. Bond ETFs or investment-grade corporate bonds may not have the same long-term return potential as stocks, but they can reduce the intensity of portfolio swings. In certain market environments, bonds can hold up better when stocks fall. They can create a smoother ride and help the investor stay with the plan. This matters because the best portfolio on paper is useless if the investor abandons it during the first real decline. A 100% stock portfolio may produce higher long-term returns for some people, but it may also create emotional pressure they cannot handle. A 70/30 portfolio is a compromise. It gives growth through stocks and stability through bonds. The goal is not to win a performance contest every year. The goal is to survive long enough for compounding to work. Now, the source makes an important point about timing. Do not obsess over buying at the absolute bottom. Timing the market is nearly impossible. Even professional fund managers struggle to do it consistently. Ordinary investors often do even worse because their emotions push them in the wrong direction. They buy after prices rise because they feel safe. They sell after prices fall because they feel afraid. That is backwards. A better approach is dollar cost averaging. Take the $6,000 and divide it across 6 months. Invest $1,000 per month. This reduces the emotional pressure of choosing one perfect entry point. If the market drops after the first month, the next deposit buys at a lower price. If the market rises, at least some money was already invested. You are not paralyzed by the need to be perfect. Perfection is not required. Participation is required. This is another principle. A good system should not depend on perfect timing. It should work under imperfect conditions. The third layer is the opportunity bullets. 20%, $2,000. This is flexible cash that you keep available for market opportunities. It is not the same as the emergency fund. The emergency fund is for life. The opportunity bullets are for markets. This money can sit in a money market fund, short-term ETF, high-yield savings account, or similar conservative place where it earns something while waiting. The source suggests it may earn 2 to 3% while idle, depending on conditions. The purpose is psychological and tactical when the market drops. Most people panic because they have no plan and no cash. They watch prices fall and feel only fear. But if you have opportunity bullets, a decline can become actionable. The source uses a simple rule. When the broad market falls more than 15% from its peak, begin deploying the opportunity money in batches. Not all at once. In batches, that matters. A 15% decline can become 20%. A 20% decline can become 30%. No one knows the bottom in real time. Deploying in batches keeps you from using all your bullets too early while still giving you a plan to act when prices become more attractive. This is how a system turns fear into behavior during the 2022 decline. Many people panicked, but an investor with an opportunity fund could look at the same decline differently. They had cash set aside. They had a rule. They did not need to decide from emotion. The market was down. The system told them to deploy gradually. When the market later rebounded in 2023, those purchases could produce strong gains. The key lesson is not that every dip will rebound quickly. The key lesson is that cash plus rules gives you control when other people are emotionally overwhelmed. Control is valuable. Now let us step back and look at the entire $10,000 structure. $2,000 for safety, $6,000 for the growth engine, $2,000 for opportunity. That is 20-60-20. The safety net protects you from life. The growth engine compounds over time. The opportunity bullets allow you to buy when fear creates discounts. This is not a complicated strategy. That is its strength. A complicated strategy can make a person feel smart, but if it cannot be maintained, it fails. A simple system that you can follow for decades is often much more powerful. Now, how do you actually execute it? The first step is to open a brokerage account. This used to feel difficult. Now it can often be done online in minutes. You need identification, basic personal information, and bank details. Choose a broker that is reputable, easy to use, low cost, and gives access to the ETFs or funds you need. Many major brokers offer zero commission ETF trades. Do not make the broker decision harder than it needs to be. The goal is not to find the perfect platform. The goal is to begin with a reliable platform and a clear structure. The second step is to set up automatic transfers. This is crucial because human nature is not reliable. If you have to manually decide every month whether to invest, life will give you excuses. You will wait because the market feels high. You will wait because the news is scary. You will wait because you spent too much that month. You will wait because you are tired. You will wait because tomorrow feels easier. Automation removes the argument, the money moves, the system buys, the habit continues. This is how investing becomes like a bill you pay to your future self. After a while, you stop thinking about it. That is exactly what you want. The third step is to choose the ETFs. If you do not know what to choose, keep it simple. A total market ETF or broad index fund can be enough to begin. VTI, VOA, VT are examples from the source framework. Each gives broad exposure. The exact choice depends on whether you want United States total market, SP 500, or global exposure. Do not waste months comparing tiny differences if the delay prevents action. There is no perfect asset. There is only what is suitable for your goal, risk tolerance, and time horizon. A good enough diversified fund held consistently can beat an endless search for the best fund that never begins. Action matters. The fourth step is to set a rebalancing schedule. Suppose your growth engine begins at 70% stocks and 30% bonds. Over time, stocks may rise faster. After a year, the allocation might become 80% stocks and 20% bonds. That means the portfolio has become riskier than planned. Rebalancing means selling some of what has grown and buying some of what has lagged to return to the target allocation. This feels counterintuitive. People do not like selling winners and buying laggards, but that is the point. Rebalancing forces discipline. It makes you sell relatively high and buy relatively low. It prevents the portfolio from drifting into a risk level you did not choose. The source uses a 6-month rebalancing rhythm that is reasonable for a simple system. It is not too frequent. It does not require daily attention. It can be done in less than 30 minutes twice a year. Review the allocation and bring it back to target if it has drifted materially. That is enough for many people. The fifth step is to keep learning, but do not overreact. Investing is a lifelong process. You should understand broad trends. You should know what interest rates, inflation, market cycles, and asset allocation mean. You should continue learning, but learning should not become constant tinkering. 1 or 2 hours per month reading financial articles, reviewing broad market conditions, or improving understanding can be useful. Checking charts every day and changing the portfolio every week is usually harmful. Retail investors often underperform the market by 3 to 5% because of frequent trading and emotional decisions. They do not lose because the market is impossible. They lose because they interfere with the system. They buy high, they sell low, they chase, they panic, they overtrade, they mistake activity for intelligence. The best investment strategy is often boring: buy, hold, rebalance, keep contributing. That is it. Now, what kind of return can this system produce? A 70 divided by 30 stock bond portfolio has historically produced around 6 to 8% annualized over long periods, depending on the time frame, the assets, inflation, fees, and market conditions. The source uses 7% as a reasonable central example. At 7%, $10,000 becomes nearly $20,000 in 10 years. In 20 years, it becomes more than $38,000. In 30 years, it becomes more than $76,000. That is without adding more money. This is already useful because it shows what compounding can do to the initial $10,000 alone. But the real power appears when you add regular contributions. If you invest the initial $10,000 and then add $200 every month, the account can grow to more than $300,000 over 30 years under the source S7% assumption. This is the lazy way to turn $10,000 into $300,000. Not by gambling, not by day trading, not by finding the next perfect stock, not by staring at screens, by building a system that combines a starting base, monthly contributions, diversification, compounding, and time. That is the point. Now, the word lazy needs to be understood correctly. Lazy does not mean passive in the sense of doing nothing. Lazy means you are not wasting energy on the wrong things. You are not trying to predict daily market moves. You are not picking 20 stocks because you want excitement. You are not changing the plan every time someone posts a new opinion online. You are not measuring yourself by every week's return. You are using a structure that lets you focus on your career, family, health, skills, and life, while the portfolio compounds in the background. That is rational laziness. It is a good kind of laziness. because the investor's biggest enemy is often unnecessary effort in the wrong direction. Now, there will be bumps. This cannot be ignored. You will see market crashes. You will see declines. You will see your account down. You will see headlines that make the future look terrible. There will be moments where the strategy feels foolish. During the COVID crash in March 2020, portfolios fell sharply. A 30% decline can feel terrible even if you understand the math. It is one thing to say you are long-term when the market is calm. It is another thing to look at real losses and keep buying. But that is exactly why the system exists. When the market falls, you do not need to invent a new decision. The system already tells you what to do. Keep buying through the automatic plan. Allow the bond allocation to cushion volatility. Use opportunity bullets. If the market decline reaches the rule, rebalance according to schedule. Do not sell because fear is loud. The market is not the biggest enemy, your own emotions are. That is one of the deepest truths of investing. Most people do not fail because the market offers no returns. They fail because they cannot stay with a reasonable plan long enough to receive them. They abandon the strategy at the moment when discipline matters most. A system is a way to override emotion you decide in advance. Then when fear arrives, you follow the decision made by your calmer self. That is how serious investing works. Now, I want to emphasize another crucial point from the source. Your investment return is not your only source of wealth. Your human capital is usually your biggest asset. If you are 30 years old and earning $60,000 per year and you work until 65, that is more than $2 million in future salary before even counting raises. Your future earning ability is a massive asset for many people. It is larger than the investment portfolio for most of their working life. That means the best investment may not always be an ETF. Sometimes the best investment is yourself, skills, credentials, communication, sales ability, technical ability, management ability, networks experience, health, discipline. These can raise income. And when income rises, contributions can rise. That accelerates the investment system. The source gives the example of a person who started with $10,000 while also improving professional skills. His salary moved from $60,000 to $120,000 because income rose. He could invest more every year. His portfolio reached more than $100,000 by age 38 and kept growing. That is the powerful combination: capital compounding plus human capital growth. If you focus only on squeezing a slightly higher return from your portfolio, you may miss the much larger opportunity to increase income. A 1% improvement in investment return matters, but doubling your income can change the whole equation. This is why I would never separate investing from career development. Your career funds the portfolio. The portfolio gradually reduces your dependence on the career. Both engines matter in the beginning. Human capital does most of the work later. Financial capital begins carrying more of the load. The goal is to move from one engine to two. Now let us return to the $10,000 allocation and summarize the operating logic. The safety net prevents forced selling. The growth engine captures long-term market returns. The opportunity bullets allow buying during fear. Automatic transfers create consistency. Dollar cost averaging reduces timing anxiety. ETFs provide diversification. Bonds reduce volatility. Rebalancing enforces discipline. Learning improves judgment. Human capital increases fuel. This is a system. And the reason the system works is that each part solves a different problem. Cash solves emergency risk. Stocks solve growth. Bonds solve volatility. Opportunity cash solves panic and missed discounts. Automation solves procrastination. Rebalancing solves drift. Learning solves ignorance. Career growth solves contribution limits. A good financial system is not one tool. It is multiple tools doing different jobs. Now, people often ask whether the returns will be exactly as projected. Number, they will not be exact. Markets do not move in smooth lines. A 7% annualized return does not mean 7% every year. It might mean up 20% one year, down 15% the next, up 8% after that, flat for a while, then strong. The average is only visible in hindsight. That is why the system must be built for volatility. If the investor expects smooth progress, every market drop feels like betrayal. If the investor expects volatility, the drop is part of the process. The long-term return is the reward for living through uncomfortable periods without destroying the plan. That is the bargain. Now, what if the market keeps going up and the opportunity bullets stay unused? That can happen. The $2,000 may sit in a money market fund or short-term instrument, earning a modest return while stocks rise. That creates some opportunity cost. But that is the trade-off. Every allocation has trade-offs. If you invest the entire $10,000 immediately and the market rises, That was best. If you invest all at once and the market falls sharply, you may regret it and panic. If you hold some opportunity cash, you may underperform in a straight bull market, but have psychological and tactical power in a decline. The purpose of the opportunity layer is not to maximize every possible upside scenario. It is to create resilience and optionality for many normal investors. That is worth the trade-off. A plan that reduces panic is valuable. Now, what if the market drops more than 15%? The system says begin deploying the opportunity bullets in batches, maybe 1/3 at 15% down, another third at 20%, another third at 25%. The exact rule can vary. The important thing is to write it down before the decline. If you wait until the decline happens to decide, fear will influence you. Rules created in calm periods protect you in emotional periods. This is one of the most important principles in all investing. Now, rebalancing also turns volatility into discipline. If stocks fall and bonds hold up better, your portfolio may become underweight stocks. Rebalancing would have you buy stocks when they are down to restore the 70 divided by 30 target. If stocks rise strongly and become too large a portion, rebalancing has you sell some stocks and buy bonds. This prevents emotional extremes. You are not guessing. You are maintaining the machine. That is why the machine matters. Now, let us talk about the psychological threshold of 5 figures again. $10,000 changes how people behave because it feels real. A few $100s in an investment account can feel like an experiment. $10,000 feels like a system. It is enough to pay attention to. It is enough to produce visible income at a 6% return. It is enough to make compounding feel less abstract. When a person sees the first dividends or interest from an investment account, something changes. They realize money can be an employee, not a perfect employee, not an employee with no risk, but an employee. It can work quietly, it can produce, it can grow. That realization is often the beginning of financial maturity. Before that, money is something you earn and spend. After that, money becomes something you allocate. That shift is enormous. Now, asset allocation is not about becoming rich overnight. It is about giving your financial life a structure. Structure reduces stress because you no longer need to answer every question from scratch. Should I invest everything today? Number the growth engine is dollar. Cost averaged over 6 months. Should I keep cash? Yes. 20% safety net, 20% opportunity. What if the market drops? Use opportunity bullets based on the rule. What if stocks outperform? Rebalance. What if I feel scared? Follow the system. What should I buy? Broad ETFs and bonds according to the plan. How often should I check? Monthly learning. Semi-annual rebalancing, not daily obsession. A system converts uncertainty into procedures. That is why it works. Now, there is one more subtle but important point. The system does not ask you to be a genius. It asks you to be consistent. This is good news. Most people will never become professional investors. They do not need to. They need to avoid the big mistakes, leaving all cash in a low-yield account while inflation erodes it. Chasing hot stocks without a plan, selling in panic, investing without an emergency fund, ignoring career growth, overtrading, paying high fees, waiting forever to start. If you avoid those mistakes and follow a simple diversified system for decades, you can do very well. Wealth often comes less from brilliance than from avoiding self-inflicted damage. Now let's think about the role of fear. It is normal to feel fear before investing $10,000. That money was earned with real time. You may have spent years saving it. The thought of seeing the account fall can feel painful. Fear is not irrational, but fear should lead to structure, not paralysis. If you are afraid of investing all at once, use dollar cost averaging. If you are afraid of emergencies, keep a safety net. If you are afraid of market crashes, keep opportunity bullets and bonds. If you are afraid of picking wrong stocks, use broad ETFs. If you are afraid of emotional decisions, automate and rebalance on schedule. Fear becomes useful when it helps you design a better system. Fear becomes harmful when it stops you from acting while inflation keeps eating the money. Do not wait until you feel no fear. You may never feel completely ready. There is always uncertainty. The market always has reasons to worry. The economy always has risks. Waiting for perfect confidence is just another way to stay stuck. The second best time to start is when you have enough understanding to act responsibly. That may be today. Now, what if you do not have $10,000 yet? The same framework still teaches you. Start smaller. If you have $1,000, maybe $200 goes to safety, $600 to growth, $200 to opportunity. If that is too little for a full allocation, begin with the safety net and a simple monthly investment. The exact number is less important than the habit. The $10,000 framework is a milestone, not a gate. You do not need permission to start because you are below it. But when you reach $10,000, the system becomes more powerful and visible. Now, what if you have more than $10,000? The same logic can scale, though details may change. Larger portfolios may require more tax planning, more asset classes, more emergency reserves, more careful rebalancing, and more professional advice. But the basic principles remain: safety, growth, opportunity, automation, rebalancing, discipline, human capital. These scale. Now, I want to address something important about bonds. Some investors dismiss bonds because they want maximum growth. Others overuse bonds because they fear stocks. The correct allocation depends on age, risk tolerance, time horizon, and emotional stability. In the source, 70 divided by 30 is used because it balances growth and stability. It is a reasonable middle path for many investors. But if you are young, have stable income, and can tolerate volatility, you may choose a higher stock allocation. If you are near retirement or very risk sensitive, you may choose more bonds. The point is not that 70 divided by 30 is sacred. The point is that an allocation should be intentional. Unintentional risk is dangerous. Intentional risk is manageable. Now, the broad ETF choices also depend on philosophy. VU gives SP 500 exposure, meaning large United States companies. VTI gives total United States market exposure, including large, mid, and small companies. VT gives global market exposure, including both United States and international stocks. Each has a logic. The SP 500 focuses on large American companies. The total U.S. market gives broader domestic exposure. The global market gives worldwide diversification. The perfect answer is not universal, but each is far better than leaving the entire $10,000 idle simply because you cannot decide between them. Do not let the pursuit of the perfect ETF delay the habit. Now, the source also says that the best investment strategy is often boring. This is hard for people to accept because boredom feels like nothing is happening. But in long-term investing, boredom can be a sign that the system is working. If you are constantly excited, constantly checking, constantly trading, constantly reacting, you may be introducing risk. A boring portfolio lets you focus on what actually matters: your work, your skills, your income, your family, your health, your sleep. Your ability to stay consistent investing should support life, not consume it. This is the whole meaning of the lazy way. Make the money work so you do not have to chase money forever. Now, let's think about the final result again. $10,000 invested at 7% for 30 years becomes more than $76,000 without additional contributions. Add $200 per month, and the projection moves above $300,000. That is the power of combining a starting base with ongoing contributions. The starting $10,000 matters, but the monthly $200 matters too. Many people overfocus on the initial amount. They think if the starting amount is not huge, the outcome cannot be huge. But the combination of time and repeated contributions changes the math. The $10,000 starts the machine, the $200 per month feeds it, the market return compounds it, the system protects it. This is how a normal person builds a meaningful portfolio. Now, if your income grows, the result can be much larger. If you begin investing $200 per month and later increase to $500, then $1,000, the curve changes dramatically. This is why human capital is so important. Your career growth can increase the fuel going into the portfolio. Do not only ask, how do I get a higher return? Ask, how do I increase the amount I can invest without destroying my life? That question may have a bigger impact. A higher income with controlled lifestyle can accelerate wealth faster than chasing an extra % of return. This is why the friend in the source matters. His portfolio grew not only because the investment system worked, but because his income doubled. He increased the engine. More money went into the system. The system compounded faster. Income growth and investing together are powerful. One without the other is weaker. Now let us talk about inflation again, because it is the reason inaction is not neutral. If you do nothing, inflation still acts. It does not wait for your confidence. It does not ask whether you are ready. It does not pause because you are nervous. Every year that cash earns less than inflation, purchasing power falls. The account may look stable, but the future value is being eroded. That is why not investing is also a decision. A decision to hold cash, a decision to accept inflation risk, a decision to delay compounding, a decision to keep money sleeping. Sometimes holding cash is correct for emergencies or short-term goals, but holding all long-term money in low-yield cash because of fear is usually not safety. It is slow loss. This is the uncomfortable reality. Now, taking action does not mean recklessness. Do not throw all money into the market without a safety net. Do not chase leveraged products. Do not buy one hot stock. Do not invest emergency money. Do not ignore debt. Do not pretend volatility will not happen. Take action through a system. That is the difference between investing and gambling. Gambling is hoping. Investing is allocating capital according to a rule-based plan that accounts for risk, time, and behavior. Now, let us close the loop on financial freedom. Financial freedom does not begin when you are rich. It begins when you realize your money can work for you and you begin building the machine. At first, the machine is tiny, then it grows, it gives you small income, then options. Options are the real goal. The option to change jobs, the option to say no, the option to handle emergencies, the option to help family, the option to retire earlier, the option to take a break, the option to live with less fear. Money is not only about buying things, it is about choice. That is why making your money work is so important. If you spend your life only working for money, your choices remain limited. If your money begins working for you, the balance shifts slowly, then visibly, then powerfully. Now, the final instruction is simple. Do not wait until you feel completely ready. You will not. There will always be market risk. There will always be uncertainty. There will always be someone predicting a crash. There will always be someone saying cash is safe. There will always be someone saying this is the wrong time. But there is never a perfect time to build a system. There is only the moment you decide to stop letting money sleep while you work. Spend 30 minutes opening the account. List your assets. Decide how much you can allocate. Create the safety net, build the growth engine, keep opportunity bullets, automate contributions, choose broad ETFs, rebalance twice a year, keep learning without overreacting, increase income, increase contributions. Let time work. That is the lazy way. Not easy, not instant, not risk-free, but simple enough to follow and strong enough to change the trajectory of a life. $10,000 may not look life-changing today, but if it becomes the first structured capital in your life, it can be the starting point of financial freedom. The future version of you will not thank you for predicting the perfect bottom. The future version of you will thank you for building the machine early enough to let it run.